I'm doing this video to provide some insights on investing. I apologize in advance for the chirping sound. I have the heat sensor on my fire alarm keeps going off. I have the sliding door closed on a hot day to reduce the chance of infection. So, judging by the recent price movements of the stock market, many of you are starting to spend the money that the government sent to you for survival. Please don't. Only spend what you need for right now and save the rest. Why? Because you have a once in a generation opportunity to make the most of it. Now please don't think this is a get rich quick video. What I am suggesting will neither be easy nor quick. However, every single one of you has the chance to become the next Warren Buffett. Do you really want to throw that chance away? Our economy has completely tanked and is at a standstill. But so long as we remain a mostly capitalist system, it will bounce back, and that presents a great opportunity. Many don't know this, but even Warren Buffett admits that without the Great Depression, he might not be the billionaire that he is now. He started investing in the 1950s, right when the American economy was bouncing back. If ever there was a time to make money on even a small investment, that was it. I tracked both Warren Buffett's and Bill Gates' fortunes when the recession hit. Both of them lost half of their fortune during the height of the recession. But you know what? Unlike everyone else, they didn't sell their assets. When we came out of the recession, both of their fortunes doubled. That's how the stock market works. The pandemic has reset the economy back to zero, for the most part. In fact, had it not been for Congress bribing Wall Street with $500 billion, the economy would be much worse than what it is. Boeing alone lost 2/3 of its market value in March, and all indications were that they were about to lose much more. Mind you, I am not asking you to invest with me. That is not the intent of this video. I am not a broker, and I have no idea how to become one. But my website can tell you where the economy is and where it's headed. It can give you a much better idea of when to get back in than what the media will. Of that, I can assure you. Right now, the media seems to be vested in the idea of making Americans feel better about life as quickly as possible. I'm really not sure why, but that's their goal. It means they will take any good news about the economy on any given day and blow it out of proportion. So stop paying attention to them. Let my website be your guide. You don't have to take my word that it's better than the media. Just click on the link below. I won't demand a subscription. I have ads to pay the bills. If the information doesn't seem accurate to you, no harm done. But I think it will. My stock market website is separate from the World Archive, but I have linked them together, for they serve the same purpose: information. What should you do with it? My broker Robinhood will introduce fractional share buying soon. When they do, it will remake the economy and render mutual funds obsolete. I know because I've done it before. The last broker I used for that sold out to a bigger broker company. I don't think Robinhood will sell out though. And when they are ready for fractional share buying, I will make a video to explain it. If you want to skip to the end of this video, I will explain to you how the Dow Jones Industrial Average works. That's the main feature of my website. So when should you invest again? Hard to say for sure. Right now, stocks are a Pandora's box. And as I said before, the major reason for the recent market uptick is because of the bribe from Congress. So that who knows if it's going to stay there or if it's going to wear off, and if it does wear off, when. Right now, there are only 3 safe places to invest: food, healthcare, and home entertainment. Navigating any of those are tricky. When fractional shares become available, it will get much easier to decide. you can Google fractional shares if you want to figure out what I'm saying. I'll wait to make a video of it when Robinhood comes out with them, because unless you can see it for yourself, it's hard to separate what it is from the regular stock market. In the meantime, let me explain why I built my website. I was probably one of the few people who watched DuckTales as a child and actually wanted to become Scrooge McDuck. He earned all of his money legitimately, so why not? You are meant to be disgusted by him swimming in a giant vault of gold coins. I always thought that would be really fun if it were physically possible. The philosophy the show gave for how Scrooge McDuck earned his money was simple. Work smarter, not harder. That line made so much sense to me, I decided it was illogical for any adult not to live by those words. And seriously, that throughout my life I have repeatedly discovered that if you don't work smarter, you have to work harder to make up for it. I have failed at many times, but I've never stopped trying. When I was a teenager, I watched Trading Places on cable one day. Whereas many would watch the movie and think about the evils of capitalism, I paid more attention to the scene involving the New York Stock Exchange. I thought what an awesome job that must be. It was just numbers and patterns, and the earning potential was unlimited. I wanted to try it. Problem is, I had no idea what these people's job titles actually were or how to find out. Wikipedia and Google didn't exist back then, and it never occurred to me to ask any adult what jobs those people had or how to be trained for it. I grew up thinking the adults would tell me everything I needed to know in life, so I just needed to wait and find out. Believe it or not, business school never came up in any of my studies. And you can thank the Washington State public education system for that. I only found out about business school many years later when I researched Warren Buffett on how to invest. And I don't particularly like Warren Buffett the person, but if you're going to research how to invest, you have to go with the best to research on, and he is the best. I thought, you mean there's a school that specifically teaches you how to either run a company or invest in one? That was shocking to me. I was instead taught that you were supposed to pick one job that you like, become really good at it, work your way up the ladder of the company, and one day you would become CEO. As it turns out, that is the mentality of the union, and Washington State is very big on promoting the union. Seriously, in my studies, I do not remember ever hearing about business school, so that is a very big gap of knowledge right there. So by the time I graduated from high school, I just assumed that investing was something that only rich people did, and that I would have to become rich before I could start doing it myself. Anyway, when Facebook went public, I decided it was just too good of an opportunity to pass up. By that time, it was easy to Google an online broker, and I bought my first share of stock. No, I didn't keep it. Like an amateur, I sold at the first sign of trouble. All of the analysts back then were saying that Facebook was doomed and that Instagram would beat them. I thought, well, they are the professional investors. They would know about this stuff better than I would, right? As it turns out, Facebook had already bought Instagram without telling the public, and they used their public offering of stock for the purchasing power. The stock tanked immediately because Instagram sold most of its shares right away. So my first try at investing was a failure, but once my feet were wet, I wanted to keep going. As it turns out, buying and selling a stock was incredibly easy, and there was a ton of information online to help me do better, so I started learning. The first thing I did seemed the most obvious to me. I tried to find a master list of all the stocks available to buy in America. I couldn't find one. I was shocked. Doesn't it make sense to know what stocks are available to buy before deciding to invest? And that's when I quickly learned how elitist Wall Street is. As it turns out, there is no master list, because knowing whether a stock price is going to go up or down isn't the only valuable information. Knowing that stock exists in the first place is also valuable information. It's easy to look up the big companies that you hear about every day on TV. But what about the other companies that you don't hear about? Either because they operate in the background or because they do business in a different state. That is very valuable information. Online brokers do allow you to download a list, but the price changes daily, and any stock has the potential of going from rags to riches and vice versa on any given day. But seriously, when I read up on many of the rules and regulations of the stock market, and they're governed by the Federal Reserve. Federal Reserve has basically one rule about the stock market: keep the common man out as much as possible, because when rich people are screwing each other, it doesn't hurt the stock market that much. It just hurts them. When the common man gets in there, the rich people want to screw over the common man to get money, and that's when the Federal Reserve is like, well, that hurts the economy, so just keep the common man out. As long as the rich people are screwing each other, it's okay. So, the online brokers allow you to download a list, but I consider downloading a list to be worth it. As I said, the prices change on a daily basis, and you literally, and I know how unlikely it is, but you actually could have Apple go down to zero in one day and have a penny stock become Apple. It's unlikely, I know, but it could happen. So I tried to make my own master list instead. Many online brokers also have a watch list, and I started adding stocks to it. I reached over 2,000 before it broke, out of over 4,000 at the time. As it turns out, it was only designed for 20. The technician on the phone couldn't believe I even made it that far. So I gave up on that for the time being and just tried to predict when a stock price would go up or down. After all, that is how you make money on it. Eventually, I discovered the Directional Movement Index, or DMI. In an ironic twist of fate, I was trained as a radio technician in the military, and the DMI looked like a modulated radio wave on an oscilloscope. I was fascinated by it. You see, there are two competing types of investors. The long-term investors like Warren Buffett, who look for good companies that they can buy and hold on to for a long period of time, usually to make money on the dividends. Then there are the day traders, who are out solely to make a fast profit, they are solely out to make as fast a profit as they can just by buying and trading any stock that they can predict in the short term. The Directional Movement Index is a mathematical formula that takes the daily transactions of each stock and analyzes them to see which type of investor is holding sway on them at a given moment. Sometimes the day traders follow the long-term investors. Most of the time they really don't. In fact, oftentimes the strategy of a day trader is to bet against a long-term investor. That's how they expect to make their money. So the DMI is trying to see which type of investor holds sway on a stock at a given moment, and it does a pretty good job at this too. The directional index tells you whether the trading of a stock is more positive or whether it's more negative. and it does this with an up and a down line, two competing lines going against each other. It's not the same as the price of a stock, which you'll see either go up or down on a given day. With the directional index, it's two lines that are actually going against each other. When done in graphic form, it looks like a mouth. The wider the mouth is, the more heavy the movement is in that direction. I used to play World of Warcraft, so I call it the Maw of Madness. And seriously, the idea of the directional index is that if a stock is really more positive and negative, which means that there's heavy buying at a given time, then the positive will go up, way up, and the negative will go way down. So that huge difference in range is supposed to mean that, oh, this stock is really popular. And if the negative line can do the exact same thing, so that means that, oh no, this stock is really tanking. The average directional index, or ADX, tells you how likely the stock is to keep going the way that it's going. And mind you, the ADX isn't meant to tell you whether it's on an uptrend or a downtrend. The directional index does that. The only thing the ADX does is tell you if it's going up, how strong is the uptrend. If it's going down, how strong is the downtrend. That's all the ADX tells you. Once I knew about the DMI, there was no going back. I would be out of my mind to buy or sell a stock without checking it first. And that's the catch. Online brokers will not allow you to download the DMI or even add it to the watch list for a stock. I know, I tried many times. It changes on a daily basis, and if you want to know what it is for each day, you have to select the individual stock to take a look. Well, what if I want to trade 100 different stocks on a daily basis? After all, Warren Buffett does say that a diverse portfolio is the key to success in investing, and I certainly don't want to have to go through 100 different stocks every single day before making a decision. So I needed a way to get the data from the websites that have it. Mind you, this information is not easily accessible. It was difficult, but I found a way. Then I needed to recreate the formula. Lucky for me, a few Google searches turned up an article that someone had written about the DMI, along with a chart full of data points to create it. Since I know how to use Excel, I took the data points and plugged them into the worksheet. This is probably a good time to tell you that not all DMIs are alike. They are not based on the current price, although the current price is the last data point. They are based on many days worth of historical prices. The number of days in the past that are factored in determine how many days in advance the DMI can predict price movement. That's what the DMI is built on, is many days worth of historical prices. It's supposed to say, okay, the traders have been doing this for this given amount of time, and how far you go back determines how far ahead it can see. As it turns out, the DMI provided in this chart was meant to predict price movement for up to a month in advance. I personally think that's ridiculous. Real-world circumstances can easily sway a stock one way or the other in any given month. However, I was able to discern the math within the formula and fine-tune it down to 1 week in advance. 1 week would give me enough time to get in or get out before it's too late. And as it turns out, when I actually finished it, it was much better it was much better of a DMI than what I've been using with the online brokers, because the main problem that I found with the DMI on the online brokers is that the ADX has way too limited a range. According to Investopedia, the ADX is supposed to go all the way up to 100. I never saw an ADX go above 50 on any stock, no matter how powerful the movement was. It never went above 50. So when you have such a limited range, it's not, a trend doesn't even start until you hit 20. And if you have a stock that has really big potential and it never hits 50, that's a very limited range to use. So it's like the moment that you get in, it could already be going down, or right when you think that you're supposed to sell off, it keeps going. So that was one of the major pitfalls of it. However, when I finished my formula, it actually extended the range significantly. In fact, I actually have historical DMI prices for the Dow Jones on my website, and if you look at the time period for which Congress issued their $500 billion bribe to Wall Street, you will see that Boeing's trend of being sold off, it was over 80, and that is the highest I've ever seen the That's the highest I've ever seen the ADX go, even on my formula. It was big. So, once I had the ability to predict price movement in advance, the next step was to save up capital to invest with. I calculated how much value I would need to buy into any given stock so that I could make a day's minimum wage if the value of the stock went up by a single penny each day. Once I had that figure, being that I was a single man with no one to provide for, I also calculated that I could save up the necessary capital within 1 year, and that would make me financially secure for life. That was the plan. Sadly, unforeseen circumstances in the real world prevented me from achieving that goal. And no, it wasn't because of the recession or the pandemic. This happened at a time when the economy was on the rebound. It was a personal matter that I could not avoid. So I decided to take a different route. I started a blog. It seemed obvious to me that if I found the information useful for investing, surely other people would too. It's possible that everyone else already had this formula and that I'm only catching up, but I doubt it. If that were the case, mutual funds wouldn't be so prevalent. As it is, I cannot imagine myself investing in a mutual fund or ETF with what I know now. There's no good reason to, and I don't consider it a good strategy anyway. Mutual funds are on any given trend, mutual funds are always the last one in and the last one out. Mutual funds are mainly to provide stock market stability with your money. That's what they're there for. As for the blog, if I could acquire a sponsor for it, then I could raise the capital I needed to secure my financial future. So I started the blog, and the hits came fast. Turns out, stock information was as valuable as I thought it was. And then I discovered another catch to the business. You see, I was trying to list all of the stocks for the entire stock market and give price movement for every single one of them. But I must rely on other websites for that data, and they don't seem to like it. Mind you, the methods I used to acquire the data were completely legal, but the websites still don't like their data being taken by other servers on the web, and there are many security steps that they take to prevent such things, even if what you're doing is entirely legal. As a result, my data feed was shut down 4 different times. The 4th time actually made me laugh. After years of searching, I found an online broker whose stated goal was to make the stock market accessible to everyone. They gave out computer code freely to anyone who wanted to use it. Apparently, though, they never thought anyone would actually be crazy enough to load the entire market into the system. You have to load each stock one at a time. It took quite a while, but I got it done. After a few months, they realized what was happening and shut the feed down. Only recently did I discover another source for the feed. This one looks like it should be permanent. Even if I can't run a blog with the data, I should still be able to use the feed for myself. And if that happens, I will make a video of it, because I mean, if I can't make money off of blogging the data from the stock market, I should still be able to make money showing you how to do it. In the meantime, once fractional sharing is allowed, I will start posting my own trades on my website. Then you will know that I put my money where my mouth is. Because unlike Warren Buffett, I don't care if you catch up to me or beat me or not. I honestly don't. I would, if the see, he made his money back when the market was available to make money. If I would. What's the point of me trying to make money off the market if the market keeps on tanking constantly from what it's doing? If you get in with me, the chances of the market being stable are much more likely, and then we both make money. Wouldn't that be nice? I'm not worried about you beating me. I know damn well that Buffett is. I honestly don't think that the man wants anyone else to be the next Warren Buffett, except for the people that he chooses. And if you've ever tried to research Warren Buffett, you would know that he does not make his good advice public. Yeah, whenever he goes on the CNBC, he says nothing of any value whatsoever. It's on YouTube videos that don't get a lot of hits, where he's speaking to fellow investors. That's when he gives his useful tips. In fact, his most useful tip about buying good stocks when they're tanking, that was from an article I found in a very obscure newspaper, and I don't think he actually thought anyone would read it when he gave the tip. I was like, oh, I found that because you didn't think anyone was actually even going to read at the time, which is why you said it. That's how Warren Buffett operates. Let's see here. You will see on my website that I only have the Dow Jones Industrial Average and S&P 500 listed. Unfortunately, I lack the resources currently to list all of the stocks at once. Maybe that will change in time. So now you have come to the part of the video where I explain the Dow Jones Industrial Average. Does it represent our economy? Yes, for the most part. Think of the Dow Jones as a survey of the economy. No, it does not list the biggest companies on the stock market. That's what the S&P 500 is for. And all of the Dow Jones stocks are on the S&P 500. Instead, the Dow Jones is a list of companies which are the kings of their respective industries. Just look at them and you can grasp immediately what they represent. Apple is for computers, Walmart is for retail stores, McDonald's is for restaurants. When these companies do well, their industries typically do well. When they do poorly, it's rarely just them. And seriously, when when they go up, okay, the vast majority of companies in their industry are also going up. When they go down, the other companies are going down. Sometimes it is just them, but most of the time it isn't. Now, some of you might say, how dare they lump McDonald's in with real restaurants? That's actually what I said when I first saw it on there. It quite literally is the lowest in terms of both quality and price. And that's exactly why it's such a good example. When people want to eat out, McDonald's is always the first place they will think of unless they can afford something better. McDonald's is the first and the last. It is a verifiable fact that even billionaires eat at McDonald's. And if you've ever watched CNBC enough, you will know that Warren Buffett actually brags about eating at McDonald's. So the final question for the Dow Jones is, why the hell does the media report it by a point system instead of by price? Took me a while to realize that too. The experts like to play dumb and pretend that they don't know why, but they all do. It came to me one day while I was listening to business news. Some reporter on the exchange floor was so excited about the Dow Jones that day that he was practically screaming into his mic about it. It went up hundreds of points! Hundreds! Oh my gosh! It was the afternoon and I hadn't heard anything exciting that morning. So I made a spreadsheet of all the stocks on the Dow Jones that day to see what he was so excited about. None of them had gone up any more than 3% that day. And for anyone who follows the market, 3% is a typical price swing for any stock on any day. And seriously, a stock can go up or down 3%, and it's not that big of a. Sometimes there'll be news saying that yes, something happened, but usually a stock can go up or down 3% on the day, and no one will think anything of it. And that's when I knew why the Dow Jones is price weighted, to make headlines like that. You see, when a company like Apple goes up even slightly, it makes the point system tick up big time. Then you can have a reporter scream into a mic about it. Mystery solved. Thanks for listening. I hope you check out my website. It is stockrankings.org.